I'll define that. It is a tax deduction. Okay, basically an advanced form of depreciation. So depreciation is an income tax deduction that you get whenever you buy a rental property, real estate business, or rental property besides for your personal residence. You get to take this deduction called depreciation. So it's based on the principle that things go down in value as time goes on, but it doesn't actually mean that your property is going down in value. You just get to literally write off the value of that property over a 27.5 or 39-year period, depending if it's residential or commercial. So that's what depreciation is. And cost segregation is just a way to break down the property into its individual components, that certain components actually depreciate faster than those 27 or 30, 39 years. And you can take the deductions of those components at a faster rate. So simply put, it's a tax strategy that allows you to take deductions earlier on in creating more cash flow by having to pay less income tax.
Love it. All right. So yeah, I mean, this is kind of how I view it too, is like there's portions of your property that are going to be worth less, right? Like in the next 3, 4, or 5 years. And the IRS allows you to say, okay, well, those are going to be, it's kind of a strange thing, right? They allow you to deduct those things that are going down value. It doesn't really matter if it's strange or not. That's the law, right? So we get to use that. And then someone like yourself comes in and evaluates a property. So let's dive in a little bit more. So what things cannot be included in this and what things can? I know there's a long list, but just generally speaking, what does that look like?
Sure. So first of all, land is not included in it. Land itself does not depreciate. So when you buy a property, imagine you're buying a house, right? Or a multifamily property, or doesn't matter what type of commercial property. There's always going to be a land component. And you'll see on your property taxes, there's a breakdown between land and improvements. Improvements means the building and everything that's in it, and as well as everything that's outside on top of the land, that we call land improvements. Okay, it's different than land. So land itself does not depreciate. So we always have to subtract a certain amount from the purchase price. And depreciation is based on your purchase price, not how much money you actually put into the property. And the amazing thing is, I mean, Eric, you mentioned before that it's weird that they're giving us this deduction, allowing us to write off, the value. But what's even more weird is that it's not even intrinsic in the value of the property itself, because this deduction starts over, and this schedule starts over every time it changes hands. Every time the property changes hands, you as the new owner can now start your clock of 27.5 years over. And not only that, you can do a cost segregation brand new, even though the previous owner did this cost segregation. Okay, so some of the things that are included are the structure. Okay, we have land doesn't depreciate. Second category is the structure. Structural components, that's really where the bulk of depreciation lies. And that's going to include your roof, walls, foundation, doors, windows, anything that is integral to the structure function of a building. But there are tons of things that are inside that are not integral to the structure. And those we call personal property, quote unquote. It's called 5-year assets or 5-year property in the names, in the eyes of the IRS, which means all of the value of those components depreciate on a 5-year schedule, and you can take those deductions of those components at a faster rate. So it used to be called component depreciation, which makes a lot more sense than cost segregation, right? But essentially we're segregating the cost of your building into different categories that depreciate on different schedules. So
okay. Yeah. So your land doesn't depreciate. So you don't ever get to deduct anything there, right?
Right.
The building, the structure itself will depreciate at the standard rate, which would be 27.5 years, which who knows how they came up with that number. Right. And then everything else, carpet, maybe interior doors, like what else is included? Everything else can be depreciated at a 5-year speed. Is that right?
Everything else inside that's non-structural. So again, that can include, like you said, carpeting or vinyl flooring, cabinets, countertops, appliances, furniture, fixtures, wall coverings, shelving, so many things, ceiling fans, anything. If you look around your apartment right now or your office, wherever you're in, you notice there's a lot of things. There's a desk, right? There's, the green screen here behind, right? All these things, there are furniture, equipment, all that stuff depreciates on a 5-year schedule. And so the job of a cost segregation company, we have engineers that specialize in this, meaning they're well-versed in the tax code and breaking down every component and knowing which category they fit in, and then create a very detailed report based on their findings and list off all the items and then make calculations to show how all that adds up to the value of the property.